Hello and welcome once again to Economy and World. Today we are going to analyze an event that could permanently change the way the global precious metals market works, and in particular, the future of silver. The topic we are addressing today is easy to state, but profound in its implications. Are we facing the end of the era of cheap silver? For many years, investors, analysts, and market participants have closely followed the signals of a possible structural shift. It was not only about watching prices move up and down, but about identifying the moment when the physical reality of the market, real supply, real demand, and actual metal availability would begin to override a financial trading system built on contracts, derivatives, and paper. According to the information available today, that moment may be getting closer. This is not a rumor, it is not unconfirmed leaks, and it is not isolated interpretations. We are talking about a shift in the economic policy of the United States, officially communicated at a high-level international meeting with the participation of more than 50 countries. However, this analysis is not only about a government announcement. The background is much broader. What we are observing in the silver market is a growing disconnect between financial price behavior and the reality of the physical market. On one hand, throughout most of the global trading day, physical demand remains strong and persistent. On the other hand, during specific time windows, especially when the United States session opens, a recurring pattern of aggressive selling in derivatives markets pushes prices lower. At the same time, physical delivery data at the main clearing centers are reaching levels that are highly unusual for this type of month. In addition, internal market stress indicators are showing imbalances that already exceed those seen during the financial crisis of 2008. All of this leads us to a central question. What happens when a government decides that the price of a strategic mineral can no longer fall freely? And what happens when a system is introduced that establishes a guaranteed minimum price? That is the core of our analysis today. Let us begin with the main catalyst. At a recent international meeting focused on the security of strategic mineral supply chains, the Vice President of the United States announced that the country will move forward with the creation of a system designed to establish price floors for certain minerals classified as critical. This information was confirmed by international news agencies and is part of a broader strategy to secure access to raw materials that are essential for industry, defense, and energy infrastructure. This point is crucial for our audience. Within the official classification of critical minerals, silver is included. This detail completely changes the interpretive framework. Now, it is important to clearly understand what a price floor system means and why its implementation has a structural impact, not merely a speculative one. A price floor is not designed to benefit short-term financial traders. It is not a mechanism intended to stimulate trading activity or generate technical moves on price charts. Its purpose is much more basic and at the same time much more powerful. The main objective is to ensure that domestic production remains economically viable. When the market price falls below a certain level, mining company margins become unsustainable. If extracting 1 ounce of silver costs more than what the market pays for it, the consequence is immediate. Investment is reduced. Projects are delayed, and in the worst cases, operations are shut down. From the perspective of a government that considers silver to be a strategic input, this represents a direct risk to national security. To prevent this outcome, the state establishes a minimum price level. In practical terms, this means that if the market price falls below that threshold, the government itself can act as the buyer of last resort, absorbing production and supporting the price. This introduces a completely different actor into market dynamics, the state. For decades, the price of silver has been formed primarily through futures markets, where most transactions do not involve physical delivery of the metal. Price formation has been dominated by financial flows, leveraged positions, and hedging strategies. With a price floor system, the logic changes. The market is no longer the only referee. There is an official reference that determines how far the value of the metal is allowed to fall. This type of mechanism is not entirely new in other industries. In the energy sector, for example, strategic reserves serve a similar function. The difference is that, in the case of precious metals, this type of intervention has historically been exceptional. And here a question emerges that very few people are asking directly. What happens if the price floor defined by the government is set above the current financial market price of silver? If the market is trading around certain levels, but the threshold for productive viability is higher, the adjustment cannot take place gradually. The derivatives market would be forced to align with the new framework. We would not be talking about a simple rebound driven by expectations or investor sentiment. We would be facing a process of structural repricing. The difference is fundamental. A rally reflects the behavior of market participants. A structural repricing reflects a change in the rules of the game. And this change does not come from speculation, but from strategic necessity. In fact, it is very revealing to observe what type of reserves the United States government has chosen to prioritize. While some sectors have promoted the idea of strategic reserves linked to digital assets, the actual decision has been to focus on physical raw materials that are essential for the real economy, the technology industry defense, and the energy transition. In this context, silver stops being only a precious metal and becomes a strategic resource. Now, while this new framework is being designed at the political level, daily market behavior is sending a troubling signal. There is a pattern that repeats with remarkable consistency. Every time the price of silver approaches a key area, around $90 per ounce, it is immediately rejected. The price not only stops rising, but reverses sharply. In several recent episodes, the price reached that zone and, within a matter of hours, fell back to levels near $83, representing declines of roughly 8 to 9%. What matters most is not only the size of the move, but the moment when it occurs. Rallies usually take place during the Asian and European sessions, when physical demand and institutional buying push prices higher. However, once the New York session opens, a wave of selling in the futures market completely reverses the move. This pattern has repeated almost identically on consecutive days. The message is clear. There is a growing divergence between the behavior of the global physical market and the behavior of the derivatives market in the United States. While buyers in different regions of the world continue to accumulate metal, financial contract selling pushes prices lower during a very specific time window. In simple terms, it can be described like this. At night, silver rises driven by real demand. During the day, the price falls due to the sale of financial instruments. This phenomenon raises a serious question about the price discovery process. If most selling pressure is concentrated in a contract market that does not require physical delivery, while at the same time real metal is being absorbed by buyers in other markets, does the final price truly reflect the real balance between supply and demand? This divergence becomes even more visible when we look at what is happening in Asian markets. Physical prices and futures contracts linked to the Chinese market show significantly higher premiums than Western prices. In practical terms, buyers in Asia are paying several percentage points more for physical silver than what is reflected in the New York reference price. This premium is not marginal. It is close to 20%. That gap confirms that the market is not uniform. On one side, there is a highly liquid financial market dominated by derivatives. On the other side, there is a physical market that assigns a higher value to real metal available for immediate delivery. We are therefore witnessing a direct confrontation between two different price formation systems, and over this entire landscape, a new structural element is beginning to cast its shadow, an official price floor system promoted by the United States government. Let us now move to the most sensitive part of this entire situation, the reality of the physical market. There is a big difference between observing chart patterns and analyzing what is actually happening with real metal, with silver that is mined, transported, stored, and delivered. This is where the story becomes far more revealing. Under normal conditions, the delivery calendar of the silver futures market is clearly defined. There are primary delivery months, such as March, May, and July, and other months that historically show very low delivery activity. February is one of those low activity months. However, what we are seeing this year completely breaks that historical pattern. During the first 4 business days of February, delivery notices were issued for approximately 14.8 million ounces of silver. That is an extraordinary figure for a month that normally attracts very little attention in the delivery calendar. To understand why this matters, we need to introduce a key concept: open interest. Open interest represents the number of contracts that remain open at the end of a trading session. In other words, how many participants still hold positions in a specific contract. At the end of January, open interest in the February silver contract stood at only 1,231 contracts. Yet just 2 days into the new month, 2,955 delivery notices had already been issued. This means that the number of contracts requesting physical delivery far exceeded the total number of contracts that were open at the end of the previous month. In practical terms, more than twice the open interest demanded real metal. How can this happen? The only possible explanation is that new buyers are entering the market specifically to receive physical silver, not to speculate on price movements. These participants are not opening positions to hold them for weeks. They enter, request delivery, and exit the market. This behavior is known as buying contracts for the sole purpose of taking physical delivery. The data becomes even more striking when we consider that this is not an isolated case. This is the second consecutive month in which a non-primary delivery month has recorded historically high delivery volumes. This strongly suggests a clear shift in the behavior of large and institutional buyers. When a participant decides to take delivery in months that are normally not used for that purpose, what they are implicitly saying is that they are not willing to wait. They want the metal now. And in a market like silver, that is an extremely important signal. While large volumes of financial contracts are being sold at certain times of the day to push prices lower, at the same time, other participants are removing millions of ounces from the system. This contrast between price action and physical flows is one of the main sources of tension in the market today. But the analysis does not stop with deliveries. There are internal metrics that help measure the level of structural stress in the silver market. One of the most widely used by professional analysts is the relationship between one-year silver swaps and dollar interest rates. This indicator indirectly reflects the cost and availability of silver within the financial system. And the current data is very clear. The imbalances shown by this indicator today are larger than those recorded during the financial crisis of 2008. They are also larger than the levels seen during the speculative peak in silver in 2011. This point is extremely important. A market can fall for many reasons. It can fall because of excess supply, because demand collapses, or because highly leveraged financial positions are being forced to liquidate. But not every price decline reflects the same reality. When structural indicators show such extreme imbalances, they are not signaling abundance of metal. They are signaling stress. They are signaling that the system is operating under growing fragility. In other words, the price decline visible on the charts is not consistent with the internal condition of the physical and financing market. It is as if the market were operating with an elastic band that is being stretched further and further. And the greater the tension, the more violent the adjustment usually becomes when it finally happens. What is truly striking is that this environment of extreme imbalance coincides precisely with the moment when the United States government decides to introduce a price floor system for strategic minerals. The question is unavoidable. Is the government reacting to signals that the retail market has not yet understood? Is it trying to anticipate a future supply problem? Or is it implicitly acknowledging that the current price formation structure does not guarantee the sustainability of domestic production? Another major actor must be added to this picture, one that often goes unnoticed by the general public: central banks. Over the past several years, central banks, especially those in emerging economies and countries outside the Western Bloc, have carried out the largest gold accumulation cycle in modern history. China, Russia, India, and Turkey lead this trend. The total volume acquired by central banks has now exceeded 5,000 tons, an unprecedented figure. This buying flow has a key characteristic: it is not price sensitive. These are not tactical purchases or speculative trades. They are long-term strategic decisions. Central banks are not trying to buy a dip and sell a few months later. They are building structural reserves. And although this process is mainly focused on gold, its indirect impact on silver is clear. Both metals share a historical monetary function and a role as a store of value in the face of the erosion of fiat currencies. In addition, a significant portion of industrial silver demand is directly linked to strategic sectors such as the energy transition, advanced electronics, communication systems, and certain military applications. All of this reinforces the idea that silver can no longer be analyzed simply as another financial asset. It is part of a global competition for critical resources. There is, however, a very widespread perception, especially among retail investors in the United States and Europe, that distorts the analysis. Many assume that if there is no broad enthusiasm for precious metals in Western markets, then global demand must also be weak. Nothing could be further from the truth. Most physical accumulation is taking place outside the Western media spotlight. While headlines focus on stock indexes, cryptocurrencies, and quarterly results from large technology companies, a quiet strategy of accumulating real assets is being built in other regions of the world. Global physical silver demand shows no signs of collapse. What does show weakness is the financial price formed in certain derivatives markets. Confusing these two realities can lead to deeply flawed conclusions. To understand why this phenomenon is intensifying now, it is essential to look at the broader macroeconomic context. Financial markets are currently undergoing a clear shift toward a risk-averse environment. Major United States stock markets have recorded significant declines in recent sessions, with hundreds of billions of dollars in market capitalization erased. Technology indexes that led the market for years are also experiencing sharp corrections. At the same time, small capitalization markets and sectors that are more sensitive to the economic cycle are showing rapid deterioration. These movements do not occur in isolation. They reflect a combination of factors: tighter financial conditions, expectations of economic slowdown, rising geopolitical tensions, and a growing perception that the global financial system is entering a transition phase. Geopolitical uncertainty further adds to this picture. International negotiations in strategic regions have stalled, unresolved conflicts remain active, and the risk of unexpected escalation stays high. As a direct consequence, energy prices have once again shown strong volatility, and each episode of geopolitical tension reinforces interest in real assets that do not depend on the payment promise of any issuer. At the same time, even within Asian markets, high volatility is visible in flows into gold-backed exchange-traded funds. On certain days, record outflows have been recorded, indicating that some short-term investors are being pushed out of the market by volatility. But this process does not invalidate the structural trend. On the contrary, it often forms part of the cleansing phase that precedes more concentrated accumulation by stronger hands. In this context, it is understandable that silver experiences episodes of short-term weakness. When the financial system moves into defensive mode, many participants sell what they can sell, not necessarily what they want to sell. Positions are liquidated to meet margin requirements, reduce exposure, and secure liquidity. That includes precious metals contracts. But here lies the key difference between the short-term and the structural horizon. From a strictly tactical perspective, the price may once again test lower levels before finally breaking through the ceiling it has been facing. From a strategic perspective, the forces shaping the market today point in only one direction: a reconfiguration of the value of critical metals. The bearish case weakens in the face of a reality that cannot be ignored: the establishment of a price floor system for strategic minerals. Historically high physical delivery volumes in non-primary months, internal imbalances greater than those of 2008 and 2011, and persistent reserve accumulation by state-level actors. The combination of these elements paints a completely different picture from what short-term intraday price movements suggest. To conclude this analysis, it is essential to focus on a clear and noise-free interpretation. First, the most important change is not on the chart, it is in policy. When a government classifies silver as a critical mineral and announces a mechanism to protect a minimum price, the market stops being merely a space for speculation. It becomes part of a national strategy for economic and industrial security. This alone changes how the future value of the metal must be assessed. Second, the strongest signal does not come from price, but from the behavior of large buyers. Extraordinary physical deliveries in months that normally show little activity reveal real urgency to secure metal now, not months from now. That urgency is not expressed by retail investors. It is expressed by participants operating with meaningful volumes and a strategic horizon. When the market is no longer used mainly to exchange paper, but to remove physical material, the message is unmistakable. Third, the enormous divergence between the Western financial market and the international physical market confirms that silver is no longer being valued in a uniform way. Two realities coexist at the same time, one dominated by derivatives and another shaped by availability, logistics, and industrial necessity. This gap is one of the main sources of tension in the system. Finally, the global context reinforces all of the above. Rising risk aversion, fragile equity markets, geopolitical tensions, and sustained accumulation of real assets by state-level actors are not isolated events. They are part of a broader reordering of the international financial system. For this reason, the real question is no longer whether silver can remain volatile in the short term. The real question is whether, under a new political and strategic framework, the market can indefinitely sustain a price that reflects neither supply pressure nor growing interest in physical metal. In the very short term, selling dynamics in the futures market may continue to set the pace. But in the medium and long term, the story being built is structural, not technical. The era of cheap silver is not ending because of a trend, a speculative cycle, or a media narrative. It is ending because governments and major institutional actors have begun to treat silver for what it truly is, a strategic resource. As always, this content is not investment advice. Every decision should be based on your own analysis, your risk profile, and your financial horizon. If this report added value for you, consider subscribing to the channel, enabling notifications, and sharing this content with others who also seek to understand the real economy beyond the headlines. This was Economy and World. Thank you for joining us.